Glenn Loury here. This is the Glenn Show. Glenn and John, we're the black guys at bloggingheads.tv. Hey there, Larry. How you doing?
Great to see you, Glenn.
And good to see you. It's good to have you back on the Glenn Show. This is Glenn Loury, and you have tuned into the Glenn Show at bloggingheads.tv and at patreon.com/Glenn Show. I'm with Laurence Kotlikoff, Larry Kotlikoff, my old and good friend, former colleague, best man at my wedding, my good friend, an extraordinary economist, professor of economics at Boston University, president of Economic Security Planning, which has the best personal financial planning software on the market. You all ought to check it out. But in any case, we're not here to talk about his business interests. Larry, it's good to see you, man, on a summer day, almost summery.
Yeah, right.
You're outside. And are you on over there on Benefit Street?
Yeah, just off of Benefit Street, right near, like 10 minutes from you. So we'll have to go bike riding later today. Or tomorrow. Today's a little tight. Tomorrow.
Okay. Yeah, we could try to find some time.
Yeah.
Larry lives in Providence, Rhode Island, as do I. It's a nice town. But that's not what we're here to talk about. Larry, I asked you to come on the Glenn Show because I know you're going to have something to say about what's going on in terms of national economic policy in this early days of the Joseph R. Biden administration. And a lot of money is going out of the door. Trillions of dollars are being spent and are being planned to be spent on infrastructure and on COVID recovery and stimulus. Tax policy is changing. The Democrats, not the Republicans, are setting the agenda now. And knowing you to be purple, neither red nor blue, I thought your perspective, and knowing you also to know what you're talking about when it gets down to the numbers on the budget and on macroeconomic policy, I thought I'd just try to pick your brain here a little bit and see what you think about what's going on. Are you concerned? And let me not try to give you your answer for you. How do you see things shaping up now?
Well, I'm one of these dismal economists who's always concerned about, always looks at the downside. And maybe I've been too pessimistic over time, but I don't think so. The reality is that we're going from a debt to GDP ratio of around 1/3, going back maybe around 2010 to something like 110% of GDP by the end of this year. So we've had an enormous expansion in government deficits, and that's been due to COVID, but just in general, lots of deficit spending under the Trump administration, so nobody is focused too much right now on that issue. And then we have all these off the book liabilities for Social Security and healthcare and defense spending through time, which if you put them on the books, raises our debt to GDP ratio by a factor of about 7, actually, as large as that sounds. It's amazing. We have a total fiscal gap around 8 times GDP. We need about 8%. We need another FICA tax and a half through time forever to pay for all the spending that we can't cover based on the taxes that we have that we're now projecting. Think about it. So
people don't know what FICA taxes are. Excuse me for interrupting. I'm sorry. They don't know what FICA taxes are. And what is this, like 15% off the top, half paid by the employee, half paid by the employer?
It's 15.3% payroll tax, up to about $140,000 these days. That's what we're short 1.5 of these tax systems. Another way to say this is that we're the extra revenue we need is about 8% of GDP forever. So we're in bad fiscal shape, much worse than any other developed country.
Can I just slow you down again? I apologize, but again, most of the audience don't know all the details. So the first statement is the on the books indebtedness of the United States government has risen from something like 20 or 30% of GDP to something like 1.something% of GDP
1.1
in less than a decade.
Well, maybe maybe you go back to 2008 and 7 before the Great Recession, and now look forward to.
Okay. So in
kind
less
of
than 15 years, we have increased our indebtedness so that it's now equal to more than 1 year's of national income. But the other point, which I think is more fundamental and I think needs to be underscored, is that the off the books indebtedness, this is to say promises the government has made for programs that are going to have to be funded, but that don't show up on the budget, programs like Social Security and Medicare, is 7 times or 8 times national income, if you count the numbers right, according to Kotlikoff. And if we were going to set the budget right so that we were actually taxing ourselves enough to pay for what we promised to spend, we'd have to double or more than double the intake from the FICA tax, which is 15% off the top of working people's wages. Did I get that correct?
You got it correct. I mean, we could expand the FICA tax to cover earnings above 140,000. But yeah, it's a big problem. And the reason we have so much stuff off the books is it's so easy to put things off the books. If I take money from you, Glenn, when you're, let's say, 40, and promise to give you money back when you're 70, have I borrowed money from you and promised to pay principal plus interest, or have I taxed you and promised to make a transfer payment to you when you're old, a benefit payment? So if we use the first set of words, borrowing and repayment, debt service, then that obligation to pay you in the future, that goes on the books. If I use the other set of words, it stays off the books. So economically speaking, you don't care whether I use one set of words or the other. Nothing in economics says that we should account for these things differently, but that's what we are in effect doing. We're kind of mixed up in our, we've had the politicians use language to keep things off the books, and then we're missing the forest for the trees in terms of our total indebtedness.
Let me interrogate that just for a moment. If you borrow from me, you incur an obligation. It's a legal obligation.
Yeah.
That there's a certificate of indebtedness that I am endowed with the power to enforce in a court of law. If you promise program benefits in the future, you can always change your mind, and there's no court of law that can stop you. The Congress can't unilaterally abrogate its indebtedness to me, but it can unilaterally abrogate its promises to me for program benefits. So it does seem to me that the language matters for the credibility of the future promise.
Well, there's lots of different. First of all, if the government can default on its debt, many governments have over the years. I had a friend, Michael Dooley, when I was an intern at the Federal Reserve back in grad school. He had his entire office papered with bonds that have been defaulted by different countries. They're beautiful. The bonds are beautiful.
Yeah.
The other thing is you can default on debt because it's mostly nominal debt by just running inflation, which we're in the process of doing, or maybe doing. So you can.
Yeah, I want to come back to that.
So I mean, just take it for example. In World War II, we issued lots of bonds to finance World War II, and then they took price controls off right at the end of World War II. The people that lent the money lost a quarter of the value of their debt because prices went up by 25%. We had a really high inflation in 1 year in 40, I guess it was 45 or 46, if you look back at the numbers. So we wiped out a quarter of the debt like overnight. And most of the debt is being held by foreigners right now, or at least half, I think, is the number. So is it going to be harder to default on foreigners or harder to default on older voters in terms of taking away their Social Security benefits? I think it's easier to default on foreigners.
Yeah, I think so too.
So I'm not quite sure. Legally, legalities don't have any economic meaning in our models, right? It's only the probabilities of certain things happening that matter. And yes.
Well, I'm saying legalities materially affect the probability of things happening. Yeah. But you just made the point that politics materially affected the seniors are more powerful than the farmers. So language does matter. I'm not going to take a complete neutrality point of view, but I do take your point that the indebtedness, the obligation, the overextension, I should say, is a real fact of our fiscal existence.
Yeah. So let me just push this just a little bit. Go back to the point about the fiscal language. You know, in physics, time and distance is not well defined. In economics, the deficit, taxes, transfer payments, these aggregate numbers, personal saving, private saving, disposable income, all these measures that we talk about to undergraduates and that are in the principles of economics textbooks, the first year textbook, all of it is garbage. None of those concepts are well defined, just like time and distance is not well defined in physics. Space-time apparently is well defined, but not those other things. So our economic equations don't determine what the deficit is. Another way to think about this is we can talk about the math in our models in French or English and German, and what language we use is would determine what we say. Okay, this model is running this deficit, but if we use a different kind of labeling or language, we would say the deficit path is this, and the off-the-book deficit is that. Fundamentally, the model will be the same. The model will be the same independent of how we label it.
Well, I have a question. We're doing theory right now, and it's very interesting to me anyway. I hope to other people. And you're making a kind of relativity point, as with the analogy of physics. And you're saying that the nominal words that we use for describing the government's fiscal position can be switched around, and you can get apparently different answers, but there's a constant underlying reality that's independent of the words. And I want you to tell me what that is. What corresponds to space-time in the world of economic relativity?
Well, that's called the fiscal gap. That's if you put everything on the books and you ask, let's take the entire path of outlays, not label them borrowing or debt service or benefit payments or public, or government discretionary spending. Forget the words, just say, okay, here's the path of total outlays. Here's the path of total receipts. In present value, do they match? That's the government's intertemporal budget. And the fiscal gap is the extent to which that intertemporal budget and present value is not zero. And where the outlays and present value exceed the receipts and present value. In the US, the fiscal gap is about 160 trillion. That's what we should be measuring. That's what Congress should be talking about and focused on all the time. And and how it's going to get resolved. Now, there was a bill.
Those numbers are so large that I don't think people could get their head around it. That's 8 years of national income. That's 8 years of national income is the difference, says Kotlikoff, between what the government over the long term has committed itself to spending and what the government over the long term has empowered itself to collect in taxes from the citizenry. Right. That's mind-boggling. And one reason it's mind-boggling is I'm wondering how it could possibly exist. Why would anybody hold our bonds?
Well, I would say nobody should if they're sure. I would certainly not hold our bonds, given what I see here. There was a bill introduced by members of Congress called the it's slipping my mind for the moment, but anyway, it was to force the CBO, Congressional Budget Office, and other agencies to do this fiscal gap analysis, and it got nowhere. Only had 8. This was about a decade ago. Only got 8 senators to endorse it. So there's something going on here about politics. It was called the Inform Act. It was to inform different generations how they're going to be treated, and it never got much traction. So there's a paper on my website at kotlikoff.net under articles with Jerry Green, the theorist at Harvard, called on the general relativity of fiscal language, which is focused on pointing out, showing mathematically that no neoclassical economics model, no model in which agents are rational. The model could include all kinds of market problems, failures, information problems, distortions. But as long as the agents are rational, in any model that we economists write down, these labeling problems exist, and the deficit will not be well defined. The taxes, transfers, all these other measures I mentioned won't be well defined as a theoretical proposition. So our theory says we're talking about, it's like an emperor's new clothes thing. Our theory is saying we have, sorry, I've got some motorcyclists around here.
That's okay.
Yeah. Our theory is saying we're talking about, we're driving in New York with a map of Los Angeles. And I think we're going to end up in the East River.
Okay, that's a good line. I wish you could spell out the details of it. But first of all, I want to just underscore how I understand the theoretical point as illustrated by your example. So the government pays benefits to people when they're old. It's called Social Security. One way of looking at it is the government is asking if it can borrow money from me while I'm working. And it hands me a piece of paper that says, I owe you. And that's my Social Security guarantee, that piece of paper.
That's your bond.
So that when I get old and I want my money, I come with that piece of paper and the government pays me my money. Now, if it does that, it has to enter into its book, we owe Glenn Loury $100 million, because that's what I plan to collect from Social Security. It has to enter into its book at a certain amount of indebtedness, and that'll go on the thing. Another way the government can do it is simply to tax me and transfer the money to old people who are alive right now, with the implicit promise that when I get old, it'll tax the young people at that time and transfer that money to me when I'm old. Right. And then it's going to look different. It's not going to be a explicit indebtedness of the government. It's going to be what? And maybe I'm not following it all the way down the line.
It'll be called an unfunded liability, but it won't be on the books. It won't add to the official debt. So this number that that they're telling us is the number that our kids have to be concerned about, or we should be concerned about on their behalf, is going to be a lot smaller because, as you said, it's like 1/8 of the true number. And
so it's not just the Chinese bondholders who our grandchildren are going to have to pay. It's also my children who my grandchildren are going to have to pay.
Yeah, absolutely. Yeah, this is an ongoing, every generation is being told, you're going to have your turn to expropriate your kids. It's a Ponzi scheme. That's what's been going on. And, we're getting to the point where it's now becoming more noticeable because the official debt, which is the only thing people are really paying attention to, the Social Security trustees, for example, have a statement in table 6F1 of their trustees report they put out every year. The last time they put it out, the unfunded liability over the long term, $53 trillion. The official debt right now is about $22 trillion. It's right there in black and white, an official report saying that, but they hid it way in the appendix of the trustees report, and the trustees didn't bother to mention it. And under Republican administrations or Democratic administrations, they don't talk about this number. It was Paul O'Neill, the former Treasury Secretary under GW, who put it into the report, and they haven't had these trustees, quote trustees, haven't had the guts to get rid of it, so they just try to hide it by putting it in the appendix.
The Social Security's unfunded liability is 56 trillion.
Might be 53. I'm going to misstate it. I think it's 53 trillion. Yep.
So Social Security by itself accounts for more than half of the total fiscal gap that you were referring to earlier.
Well, I would say if the way they measure it, it accounts for more, but it's actually, I would measure it at a much smaller number because they're using too low a discount rate. They're valuing these benefits in the future at too high a price right now.
Technical detail, but I get the point. Yeah. So again, I'm back to my question. how can this be? I mean, obviously it's not sustainable. People worry about climate change. Well, how about fiscal collapse? This is not sustainable forever.
No,
Something's
and
going to
people,
have to give.
it's like,
Right? I mean, really, and I'm going to sound naive here. What's going on? Bondholders in Saudi Arabia or in Beijing they're not stupid. They want to get paid, or they want their grandchildren to get paid. They're going from period to period holding this debt, but they can trade it anytime they get ready to. So they know that a piper is going to have to be paid down the line at some point, maybe not tomorrow, maybe not 10 years from now. Their money managers have to know this. There's going to be a reckoning. I mean, there's no free lunch. So talk about that.
Well, I'll just give you an example. In 2008, I went to China right after the collapse of Lehman, and we had a meeting with 50 top economists in China. There was a huge public meeting, and these guys actually started screaming at me about U.S. fiscal policy. They said, China has all this debt, and you guys are going to be printing so much money, you're going to produce inflation. And they were actually screaming at me. I'm talking about screaming. And so some people are aware of this, but has it changed? It may be the Chinese government is buying U.S. bonds in order to extract some leverage over the U.S. government in terms of, how it acts towards China. I don't know, but I can't figure out how anybody who's rational, who's really informed about, just look at the Congressional Budget Office projections, you'd conclude just, the numbers I'm using to get to the $160 trillion fiscal gap are coming right from the Congressional Budget Office.
So anybody can see them.
They're just not putting the numbers together in one sum. Okay.
Now, how about this? I wonder how you react to this. And this is just me speculating off the seat of my pants. They know that a reckoning is coming, and they certainly don't want it to happen. Not on their watch. That's why they're screaming at you in Beijing. On the other hand, compared to what? What are they supposed to hold? They have to hold something. What are they supposed to hold? I mean, what are the alternative assets that are any more secure? So, and moreover, if they try to get out, they'll ruin themselves. If there's a flood of the market of U.S. debt, the people who are the biggest U.S. debt holders are the one who's going to take the biggest hit. So in a way, we kind of have them by the short ones a little bit, so it seems like it's a more subtle and interesting game than just pay up,
Yeah. But if I were China and running their, foreign currency reserve, would I be holding government U.S. treasuries? No. And what would I invest in? I guess I would invest in U.S. stocks, maybe, but not treasuries. I would. It's not clear we have a safe asset in the world. Other countries' debt, probably Australia, New Zealand are two fiscally, or Canada. These are fiscally responsible countries. That's probably it. If Chile has been fiscally responsible, but it's got so much underlying social unrest that one doesn't know. So I'd say if I were thinking about buying bonds from a country, I would say Canada, New Zealand, or Australia would be it. I'll just give you another, I know we're kind of straying off Biden. We'll get back to Biden, but
no, that's fine.
I'll just give you another story. I was asked by the New Zealand central bank to spend about 10 days there as some kind of a fellow a few years back. And I arrived after this huge long flight, exhausted. I'm sitting in the taxi listening to the radio. The guy had the radio on. It's a talk show. And it was listeners were calling in and screaming about the recent superannuation report. That's their pension system. That's their term for pension. Mm-hmm. So it's in effect a trustee's report for their Social Security system. And they were so outraged that there was a minor, trivial fiscal gap in that system, not 53 trillion, not 2 years of GDP, or 2.5 years of GDP, but something like, maybe 2% of GDP. And there's, one long ride from the airport to the town, one person after the next was so upset about this. This is a big deal in New Zealand. We can't get anybody, not even the politicians, to focus on this stuff. And so the entire mindset is we actually care about our kids. We make sure we're not screwing them over. And Italy, Italy, you think of as having a high debt to GDP ratio. They do. It's probably like 150% of GDP official debt. But they've had 4 pension reforms in recent decades that have reduced their Social Security unfunded liability. So they're actually, on a fiscal gap basis, in better shape than than Germany, than France, and far better shape than the U.S., according to the European, what's called the European Council, which is a part of the European Union. It's a agency of the European Union. They do these calculations. They do fiscal gap accounting for the EU for all the member countries. And they put this out. It's called the S2 indicator. They put out a study every 3 years. They've been doing this for quite a while now. So they do. So they are concerned, but and they look better. So if I were Chinese, I would buy Euro bonds rather than U.S. Treasuries.
Well, I have no idea how much the Chinese have to invest, but they'd probably be able to buy all of those bonds and still have a whole lot of money left over that they would need to invest. The scale is also an issue, but that's New Zealand or Canada. But let me ask you to respond. We're talking now about the fiscal gap, to 2 intellectuals whom I know you know of. Do you know Mark Blythe, the political economist, my colleague here? The book is called Austerity. He's a Scotsman. He's a professor here at Brown in the Watson Institute and in the political science department. He was at Johns Hopkins before that. His book is called Austerity. And he says, a pox on all you fiscally obsessive, anally obsessive budget balancers. The pursuit of the banner of austerity has driven many EU economy into recession. It's all about the bankers not wanting to take a hit, and it's some kind of ideological belief system that people have. It's not really grounded in solid economics. Don't worry. So Mark Blythe, anti-austerity. And then there's Paul Krugman. You've heard of him. Nobel laureate, writer at the New York Times. And he's been saying, and I know you're not a Republican, but he's been saying, Krugman, that the Republican economists have been telling us time and time again, inflation was right around the corner. They bellyache all about the deficit. And guess what? The reckoning has not come, and it's not going to come either. Then he has his reasons why. So what do you say to these guys?
Well, economics, if it has anything, it has budget constraints. And what it's, if they were right, I would say, well, fine, guys, Mark and Paul, let's cut taxes to 0. Indeed, let's make them negative. And let's make them negative, big negative forever, and see how well that works out for our country. Let's look at history. Let's look at Argentina, that has been running these kinds of policies for a century and went from the 5th highest per capita GDP country so it was a developed country to a developing country over the course of a century of running these kinds of policies. Or let's look at the 22 hyperinflations that occurred in the last century, and where countries went bankrupt.
Let me answer on their behalf.
Of countries going under, and it can happen overnight. I mean, it can happen.
Okay.
People can see that Enron, once they looked really at the books of Enron, the long-term books, because Enron was keeping stuff off the books. Enron was out of business overnight, and our country can be out of business overnight too when its lenders observe what's really going on. They really understand it. Let me just tell you one other story.
Well, hold on. Before you do that, I just want to answer on their behalf. No one is saying that there are no degrees of deficit that matter. We're saying the historically engendered degree of deficit in this particular case doesn't have the effects that you would say. And they would say, I am looking at history, not the history of Argentina or Weimar Germany. I'm looking at the history of the United States over the last 20 or 30 years. And what I think I'm going to stand on is they want to hold our debt because they don't have any place else to go. And because it's not a bad bet, it's a good bet to hold our debt.
Well, meanwhile, when they hold our debt, they're taking their savings and investing in the U.S. Up till COVID, we were not saving as a nation more than 3%. So our national saving rate has gone down the tubes. This is exactly what you predict when you take from young people and give to old people. Young people are savers, old people are spenders. If you take from the savers and give to spenders, you get more national consumption, less national saving. So from 1950 through now, our national saving rate's gone from about 13% down to about 3% pre-COVID. Now people are scared they might start to save more, and consume less. But so what I'm trying to get at is that our GDP can look pretty good and can grow pretty rapidly based on foreigners bringing their capital into the country, and we use that to produce with. But our national income, what we Americans actually have in terms of labor income and also asset income, if we're not accumulating assets, if we're not accumulating and keeping up with terms of wealth accumulation, then our national income can decline or not keep up with other countries. And that's what I see happening here, that in an international context, you have people now are under the belief that the U.S. is a safe place to invest, and they're investing a lot. And we are consuming a lot because of our fiscal policy, which is now going on for decades of taking from the young, giving to the old. And so we have this underlying decline in national income as a share of global national income that we're not seeing because we're not looking at those numbers. We're looking at GDP numbers. And this may continue for a while, but it may also come to a point like it did for the UK, where the dollar goes from being the world's reserve currency to being just another currency, and maybe the yuan takes over, the Chinese currency, or some other currency, maybe the euro takes over from the dollar. So it's not the case that U.S. economic hegemony is guaranteed. These folks who are saying, well, we can run this, we haven't seen any problems, and therefore we can keep, it's like having cancer and saying, well, so far it hasn't killed me, so I don't need to have an operation. I'll just wait till it gets bigger and worry about it then. That's what I see, a growing cancer.
So I understand your answer excuse me, I just want to make sure I understand you. You're responding to the anti-austerity and inflation as a boogeyman economist by saying, there's a problem here, we should be able to see it, it's in the structure. In the nature of the case, when things go dark, they'll go dark quickly and we won't see it coming. But the underlying structure is sending a message and you fail to heed it at your peril.
Yeah, if you look at some of the fundamentals, like the age consumption profile, it used to look like this. 70-year-olds were consuming about 60% of what a 45-year-old was consuming. Now they consume about twice of what a 45-year-old consumes. If you look at 1950, the age consumption profile looked like that. Today it looks like this. There's cross-section, average consumption by age. That's showing you that we've had this big tilt in the consumption of the old people relative to the young people. And that didn't happen on its own. That happened because of policy. And so that's another indicator, the national saving rate declining.
And when you consider, this is so interesting that it's young people, 40-year-olds and younger, who are raising children. And that if those households are income constrained with respect to investments they can make in the children's development, then this shift in the age consumption profile that you're describing, such that older people are now consuming relatively much more compared to younger people than had been the case in the past, means that children are getting access, relatively speaking, to less developmental resources invested in them than heretofore, because we have to assume that the altruism of grandparents toward their grandchildren is less robust than is the altruism of parents toward their children.
Yeah, there's no altruism in this country to speak of between generations. This is why we're ripping off our kids. And you know, when you take 15, like we talked about the FICA tax being 15.3%, that's going right out the door. That's money that you could otherwise be investing, saving and investing. And now you're giving it to your parents, and now you're in a state of dependency. So you're relying, when you reach old age, on your kids. But if they're not as productive, and if they're, because they're not as well educated, if our education system is breaking down, which it is, and if the demographics are such that we're having relatively fewer kids, which we are, and getting to an aging society, then there's even more pressure on this Ponzi scheme of breaking down. So what I'm trying to get all across, I kind of did a little, I was trying to respond to what's going on fundamentally, but some of what we're not seeing is because of this international global economy that we're in. That if we were a closed economy where foreigners cannot bring our capital, and our saving rate went from here down to here, we would have a kind of a capital shortage, and our interest rates would be up. And that would be another indicator everybody would see that, hey, there's something wrong with the US. It's not saving enough. It's got very high returns to capital because there's a capital shortage. But capital has been flooding in from abroad, from countries that are high savers. So it's masked. What I'm trying to say is that we have these underlying things that we're not seeing in the fiscal area, in the real economy, and in the global economy. We're not seeing this path of decline as our national income as a share of global national income. It's projected to decline. In a study I'm working on now with some other economists, it's projected to decline from about 15% of our GDP is about 15% of, say it this way. Right now, we have about 15% of world GDP. China has about 15% of world GDP. If you look at the end of the century, the simulations I've been running with colleagues show that our GDP will be about 12% of world GDP. China's will be about 28% of world GDP.
Wow.
So 26%, 28. So, and that's GDP. Now, if you look at national income, we're going to be more like about 8% of world national income, because a lot of our GDP through time is going to be really the result of other people's investment in the US, and the return goes to them. It becomes their national income.
Okay, let me ask you a question. How could this be anything other than what you would expect if there's some kind of long run convergence, since technology is free to move across borders and capital is, in fact, free to move across borders, and there's diminishing returns? I'd expect a relatively low capital per worker countries to attract capital and to be on the steeper part of the income curve, so that the US is only 5% of the world's population. We can't be 20% of the world's GDP forever. If there's growth in countries and there's a common underlying technological production possibility. That they taught me that in Econ 101, Larry.
Yeah, no, that's the reason. I mean,
I expect the Chinese to catch up. Even if they're 28% and we're 12%, we still have a higher per capita income because they got almost 2 billion people over there.
Well, eventually their per capita income will, catching up means catching up in terms of labor productivity. And China's population is actually projected to decline by about 400 million by the end of the century, according to the UN. So this model does have catch-up growth in the different regions. And its paper is going to be called the Future of Economic Power. It's going to come out later this summer. And so what you're saying is actually, 100% true, that these real forces, productivity catch-up, demographics, that really matters for GDP in the different countries, because if you have a declining labor force, then you're going to have less capital flow in, but less capital come in because there's less labor to work with. But capital is going to move around to get the highest return. So GDP is, important and interesting, but regardless of that, there's national income. And you can be a country that can have a high GDP and a very low national income because you are not saving at all. And you've wiped out your saving. And just think about, these islands in the Caribbean, like Puerto Rico. Well, Puerto Rico is a part of our country. But
hold on, before you go on, that's because foreigners have some claim on the GDP. So the net national income is short of the GDP by the amount that the people who lent you the money to build the stuff take out in interest and profits.
Exactly. Yeah. That's exactly right. And so that's why our share of national income is going to decline faster than our share of GDP. They're both going to decline. Of world national income, our share is going to be, we're going to be like a second-rate economic power in terms of our true national income by the end of the century. We're going to be akin to Germany, to the world economy today. Not nothing, but not a dominant.
We look forward to seeing this paper. Can anything be done about it?
Well, that gets us through policy, and we wanted to try and restore the economy, keep people optimistic. A lot of the short-run macroeconomic policy is, I think, geared towards coordinating everybody's behavior, getting everybody on the same page, so that we don't all get, scared and start firing our workers. Yeah. And that's what all this current deficit finance has been about under COVID. But it comes at a price. We could be taxing rich people to give to poor people who've been laid off, but we're not. We're taxing future kids to pay for the current COVID relief bill, and the one that was, the relief that was passed under Trump. So I'm concerned that we're getting into we're digging a deeper hole. We had a huge hole to begin with, and through COVID, we've made that much deeper, and it's our kids that we're putting in the hole, that are in the hole that we're digging deeper for, and we're piling higher and higher, bigger and bigger bills on their laps.
Again, let me underscore what's being said here for the non-economists who might be listening. We want to avoid a Keynesian-style recession/depression of the sort that we experienced in 2007, 2008, and so forth, the Great Recession. A inadequate demand-driven recession because of COVID, and so we have to pump money into people's pockets. You're okay with that? You're concerned about doing it on the deficit instead of doing it by the taxing of the people who are relatively better off and transferring those funds above board, as it were.
Yeah, people like you and me. If this were
watch out now, watch out. Yeah. You're raising my taxes, Larry, man.
Raising your taxes, exactly. We should be the ones who are footing the bill to help people that have lost their jobs. The ones, who can do this, use this in their jobs, this technology, and can maintain, we're able to keep working, and in some cases do even better under COVID. They should be paying the bill for this relief.
Now, Biden has said that nobody with incomes under, what is it, $140,000 a year or something like that, will see their pardon?
400,000.
No one with incomes under 400,000 will see their taxes go up. So isn't he doing what you advise?
Well, he just, passed this huge bill, $2 trillion package, and there was no tax increase on anybody. So it wasn't like he taxed us to pay for this relief. He said, well, we're just going to borrow the money. And then the Federal Reserve is coming along and printing money to buy back the bonds. So this is the other part of the equation that we haven't talked about yet, which is the debt to GDP is getting, going soaring. And that's the debt in the hands of the public. But through this process, the Federal Reserve has been also printing money out the wazoo. The basic money supply, what we call the base money, is 6 times higher than it was in 2008 today. Wow. So, and prices have not risen. So, your Paul and Mark would say, well, or these new modern monetarist theorists or so-called theorists would say,
MMT.
yeah, why are you worried about this? We've printed all this money and prices haven't risen, and therefore we should just borrow more money and print more money to buy back the bonds and just basically inflationary finance all this spending, and prices will never rise. Well, I think that's extremely irresponsible, because we have the basis right now for a massive increase, like a six-fold increase in the price level. If the velocity of money went back to where it used to be, we could definitely see an increase. And even just if we have so much money floating around,
you're not forecasting a 600% increase in prices over some defined period of time. I know you're not doing that because you're a sensible guy.
Well, I'm saying that if you look at the basics, we have the potential for a high inflation. Now, the Fed would say, if Jerome Powell, the Fed chairman, were here, he'd say, well, Larry, you're stupid. Well, he wouldn't say that. He's a very, very polite person. He'd say, that's nuts, because if that started to happen, we would take our bonds and we'd suck back the money by selling these bonds back into the market. And the Fed has that ability, but that would lead to
interest rates going up through the roof and recession.
So, yes, the Fed is in a tough bind here, because if you sell bonds, you're going to lower their price and raise interest rates. So we have, engaged in irresponsible monetary policy as well as irresponsible fiscal policy. And this stuff, can go on for a while, but at some point, when you start acting like a third world country in terms of your fiscal and monetary policy, it catches up with you. That's what I'm ultimately concerned about, that we're in a path, we're like on a slow path to Argentina, it seems to me. We're kind of mimicking their behavior. It hasn't quite bit us in the tush yet, but I think it will.
Okay. Well, I hope you're wrong, but I actually, if I was a betting man, I'd not bet against you. What about the Biden administration's larger philosophy for tax policy? So they want to tax the rich, so do you. They also want to raise corporate income taxes. And I didn't think you were in favor of that. I thought you thought if Trump's got anything right in that tax reform that they got through the Congress when he was president, it was that he was getting closer to correct about the corporate income tax. Did I read you accurately in that? Not that you want to say anything positive about Trump. We're talking about taxes, though.
Yeah, fair enough. Well, that reform of the corporate tax wasn't originally designed by Trump. He didn't understand it. The Republicans, it actually was a proposal that Alan Auerbach came up with. He's a Democratic. Well, he leans Democratic.
This is the professor of economics at UC Berkeley who writes papers with Laurence Kotlikoff from time to time.
Yeah. So Alan came up with a proposal, which then got watered down. So it ended up, the final Tax Cut and Jobs Act, corporate tax reform wasn't what it should have been, but it was better than nothing for sure. And
please tell people why it was better than nothing and why you might have a problem with Biden going in the opposite direction on corporate taxes.
Well, we want to make sure that people have an incentive to invest in the U.S. And if we have a very high marginal corporate tax, which means that at the margin, every dollar I invest here, every dollar of profits I earn, I have to lose, let's say 35 cents on the dollar. I'm going to be less interested in investing here than in Ireland, where it's a 12% marginal tax rate. So having the kind of the highest or one of the highest marginal tax rates on investing in the U.S. wasn't a good idea. Now, so he brought, Trump brought this down in that bill that got passed, and Biden would like to raise the nominal corporate tax rate back up. And I would say, look, we want to keep the incentive to invest here where it is, or even lower it. But why don't you do this, President Biden? Raise the corporate tax rate, the nominal rate, but also expand what's called expensing. So do something else, which will keep the marginal effective tax rate low at the same time.
Wait a minute, hold on. You're the guy who said words can be food with any way you want, but all that matters is the bottom line. And it looks like you want a bottom line lower corporate tax rate. You just want to call it something other than that.
No. Actually, this is raising the average corporate tax, but lowering the marginal corporate tax. So
okay, that's an important distinction.
Yeah. So the way this would work is you would raise the corporate tax from, I think it's now at 21%, 21, 22, up to, I think he wants to put it up at 28%. But at the same time, you would expand expensing. You can now, if you're an investor and you're putting new money into the economy, new investment, if you buy a computer, you can write it off. If you buy a building, you have to depreciate it. So I'm saying, let's let people write off investment in structures as well. And this will keep the effective corporate tax rate, marginal rate, down. But this is a break that new investors get for new investment. But for old investment, if I have a company and I put up a building 10 years ago, I'm not going to bought a building. I'm not going to get any break. So my profits are going to be taxed at this 28% number. But the incentive to invest, the investors at the margin will say, those folks will get a tax break for investing. They'll get the expensing. So that's where you get more revenue without affecting the incentive to invest in the U.S. It's called intelligent design of fiscal policy. And we also have to worry about, I'm not for taxing the rich and putting them into a 70% tax bracket, which, or 65% tax bracket, which could happen if we did what Biden is proposing on taxing Social Security of people, applying the FICA tax, that 15, or the 12 the Social Security FICA tax to people earning more than $400,000. That's part of his original campaign proposal. This would put
God help us.
Yeah, this would put high earners, people earning more than $400,000 are very productive people. Potentially, well, we think they're productive. Some are getting it by luck, but this would put them in a 65% marginal tax bracket. Could be even 70% in California. If you add all the things together, we don't want to induce them not to work. We don't want to have poor people, many of whom are in a 70% or higher tax bracket already, because they lose benefits, so many pennies on the dollar if they earn more money. We don't want to have people in the high tax bracket. So whatever Biden does, he needs to fix incentives to work. We need to get more taxes, but we'll do it in an intelligent way, just like with a corporate tax. Get higher tax revenue without affecting the incentives to invest in the U.S. Get higher tax revenues from labor income without while also lowering the distortions on labor supply. The tax.
Okay.
So raise the average tax, but lower the marginal tax across the board. And I ran for president. I don't usually talk about this when I talk to you because I'm not. Some people think it's kind of ridiculous I did this, especially some of my relatives. But I did this in large part to write a platform which would say, here's how I would fix the tax system if I were president. And here's how I would fix Social Security. And here's how I would fix healthcare. And here's how I would fix the banking system. So that platform is right on my website at kotlikoff.net. It's a free download. It's called You're Hired. It's a book called You're Hired. And I transformed the platform into a book for President Trump. I said, look, you're elected President Trump. Maybe you can read this book. And the week after he was elected, I put it out. It says, You're Hired, a Trump playbook for fixing America's economy. And I don't think you read it. I don't think anybody in the administration read it.
Well, the second is the most significant thing. Of course, he didn't read it, but he should have had somebody working for him who read it, who could then whisper in his ear. But we're getting toward the end, and I want to make sure a couple of points get explored. Now, one of them, I can hear what people are going to say defending the increase in the corporate income tax, acknowledging your point about the important distinction between average taxes paid by corporations on their earnings and the marginal tax paid by someone considering making a new investment in the United States. That's an important distinction. We don't want the marginal rate to go up. One reason we don't want the marginal rate to go up is because they can take their money elsewhere. They could go to Ireland or whatever and invest their money in a factory or whatever, and we're competing. Now, one possible response to that is this is a race to the bottom problem of the global economies. And if we could all get on the same page and raise our corporate tax rates together, we could avoid the problem of chasing people away with their investments. And why can't we just have a conference, and get around the table and agree that we're going to raise corporate taxes and do so in coordination?
Well, Janet Yellen, was a PhD economist and was my
I've heard of her. She and I are MIT alums.
Yeah, and Janet was my macro professor when my first year in grad school. So Janet's proposing exactly that, to try and get all the countries, all the leading countries to agree on a corporate tax. We have an expression in Yiddish. It's called alavai. She speaks Yiddish, a little Yiddish herself. It means I should live so long.
Uh-huh.
The European Union cannot get Ireland to raise its corporate tax. They lowered it from like 50% down to 12%. There was a huge boom in Ireland. It's called the Irish Miracle. And now they're trying to get Ireland to raise it back up to the same level as all the other EU members. And that hasn't happened. Ireland might be forced to do that at some point, but it will. So this is not easy to get agreement and once you get agreement to maintain behavior, right? It's got to be cooperative.
In other words, they might cheat.
Yeah. So
they find ways of changing the words around to act as if they haven't lowered their corporate taxes, but in fact will have done so. Perhaps by accelerating the depreciation write-off of structures.
Yeah, exactly. Right off the structure. That's exactly one way to do it. Or to have, the federal government subsidize the local towns to give breaks to corporations that invest there, especially foreign corporations.
Okay, Larry, I got to ask you one final question here. And this is economist to economist, okay?
Okay.
Now, Mitt Romney got savaged when he reportedly said to a microphone somewhere, corporations are people too. The Democrats had a field day. But here's my question, economist to economist. Wasn't he right? I mean, in other words, isn't the corporation, I'm serious, people are going crazy. We're going to tax wealthy corporations. Elizabeth Warren, Bernie Sanders, they never tire of inveighing against wealthy corporations. Here's my point. Tell me where I'm wrong. A corporation is just the legal nexus of a set of contracts between various stakeholders. They have employees, they have suppliers, they have customers, they have bondholders, they have shareholders. That's all the corporate. There is no such thing as the corporation. It's a fiction. It's just a legal entity. Now,
Absolutely.
Taxing corporations means getting some money that would otherwise have gone to their workers, their customers, their bondholders, their stockholders, their suppliers. That's all it means. All you're doing is taking the money out of a pot. The pot ultimately redounds to the benefit of some people and the detriment of other people. There is no such thing as a corporation as far as the morally significant assessment of our tax policy. So when people talk about wealthy corporations getting away with tax breaks, what they really mean to say is pension funds who hold the shares of those corporations, unions whose members work for those corporations, suburban moms who shop at the store and buy the products of those corporations, Chinese bondholders who hold the debt of those corporations, et cetera. There is no corporation. Now, what's wrong with that? That just seems obvious to me.
No, it's obvious to me too. I mean, I agree 100%. There's nothing wrong with it at all. And, one way to deal with the corporate income tax is just to get rid of it and say, look, the shareholders, every year the corporation has a profit. If I've got 2% of the shares, my taxes, I have to pay 2% of the profits in personal taxes. So we just allocate each year's corporate profits to the owners of the corporations, and they have to pay taxes, make it a pass-through entity, just like if you're a small business corporation, like an S corporation. This already occurs with those corporations. So we can move C corporations, corporations can be, or facing the corporate tax into pass-through entities and deal with the corporate tax that way. Get rid of it and make it clear that it's actually paid by individuals. Now, there's a bigger question as to whether it's really paid by the shareholders or really paid by ultimately being borne by the shareholders or by workers. And this is part of why I'm so concerned about not making us uncompetitive in terms of foreign investors. If foreigners don't invest in the U.S., because we're not saving, as I mentioned, so we need the other people's savings to come into the U.S. If they don't invest in the U.S., then our workers will have less capital to work with, and they'll be less productive, and therefore their wages will go down. So even though it will seem like I, a shareholder of a corporation, am paying a higher tax, ultimately I can take my money and also invest it abroad. I'll pull out of the U.S. too, to some extent, and the workers in the U.S. will be left holding the stick. So we have to really understand that who the government says it's taxing doesn't necessarily correspond to who is actually bearing the burden. And in this area of corporate taxation, I think it's really the workers that are paying the corporate tax, and that's the principal reason I'm so concerned about knee-jerk fixes to the corporate tax, or raising it without thinking through how this is going to impact the economy longer term. But I think Biden can have his cake and eat it too if he does some intelligent design. So I'd be happy to help him in that area.
Well, I hope he calls on you. This has been Laurence Kotlikoff, professor of economics at Boston University, my good friend. And so glad that you gave us some time to break it down. Larry, we did economics at the Glenn Show. They say we don't do enough of that. So I'll try to get you back soon, okay?
Oh, sure. Well, I think I'm your, apart from your sidekick, I think I'm
John McWhorter.
John McWhorter. I think I'm your most frequent guest on your show historically. Can you tell me that?
We could look it up in the archives. I'm not sure. It's possible. It's certainly possible. But the thing that gives me the most joy is that you're proud to be able to say so, Larry.
I'm extremely proud. All right. Anytime.
Okay. Take care, my friend.
You too.